this morning, and I could see the little buds on the saguaro cacti at the top. That's when we know it's summer, when the giant cactus that are like 20 feet tall, when they start to bloom, that's the summertime. So we're not quite there yet. How about you, Mark? Where are you?
I'm in Portugal,
Oh,
and we've had a fantastic year. Apart from the first 2 weeks of January when we had rain, it's been blue sky most days.
that's
So,
beautiful. Where in
uh,
Portugal are you?
so I live about 35 minutes northwest of Lisbon Airport.
Oh, that's
So
great.
great part of the world. It's easy to get to Lisbon, to the capital, but we're on the coast in a little fishing village.
Ah, that sounds beautiful. Well, hopefully I'll get to come visit you at some point. I'll be
Yeah,
in
yeah. If you
Italy
ever
in a
want to.
couple of weeks. Yeah, I would love to. I
Yeah,
mean, you know, I got to try drinking port in the home of port, right?
absolutely. Yep. Yes, it's been the last visitor we had. You might know Trent McLaren came out here, and we met up with him for a couple of evenings, which was fun.
Well, everyone has joined us. We're going to go ahead and get started. We're talking about value pricing today, and we've got the, I would say, one of the masters of value pricing, Mark Wikersham, talking today with him about it. Mark, welcome to Grow and Scale, our series by Financial Sense. Tell us a little bit about yourself and what you do.
Yeah, sure. Thanks, Blake. Yeah, so I am an accountant by training from the UK. You can probably tell from the accent, and I've been in the profession now for, well, it's over 30 years. It was 1988. Wow, I am that old. In 1988, I went to work for a large multi-partner firm in the UK, did the usual process of spent 3 years on a training contract, qualified as a chartered accountant, spent 3 years specializing in tax, became a tax manager, and then decided in 1996 that I decided I wanted to be my own boss. So I built up my own accounting firm. I had no clients. I just had a spare bedroom, bought a computer, bought a desk, and went out looking for work. And grew surprisingly fast. Outgrew the bedroom in 2 months and went into premises. Hired 3 people. Outgrew that in 15 months. And 2.5 years later, I'd grown to 200 clients, and and my fees were pretty. I had a team of about 8 or 9 people. And it might have looked like I was successful. If you're looking on the outside looking in, you might have thought, wow, Mark's a pretty good sole practitioner, growing crazy fast. The reality was, by the end of 98, my life was a mess. I was working crazy long hours, struggling just to meet the payroll at the end of the month. And it wasn't until really 1999, everything started to change. I met some people that changed my life. One of whom was Ron Baker. I first met him in 99. He was the first person to explain value pricing to me. And that's when this light bulb went on in my mind, and I realized there's a better way of pricing. And the very first thing I implemented in my firm in late 99, I increased my average price by over 3 times for one of my services. I was able to turn that mess of a practice around within a year or two, then sold it to my client managers in a management buyout. They bought it from me. I think they still run it to this very day. I think it's still called Wickersham's even. But I started then teaching the profession, which I've been doing for the last 20 years, teaching the things I figured out, how to build a more successful, profitable accounting firm.
Did I hear that right? You increased the revenue on one of your service lines 3 times?
Correct. Yes.
What was
Yes.
that?
So that was I did a lot of tax was the thing I did enjoy doing back then, and one of the things that I did quite a lot was when I went to see a potential client that was trading as an unincorporated business, so a sole trader business, partnership, and if there were tax benefits from incorporating, so I think you call it Schedule C, we call it limited company. Then we call that service incorporation, where you move the trade from one entity to a corporate structure. And in the UK at the time, the most firms charge £200 or £300 for that. In fact, I've done benchmarking studies just in the last 12 months, and firms are still charging less than £500 for doing that. And yet I figured out a system for pricing it better, and I got no pushback whatsoever and was getting 3 times the price. And I then, after I sold my practice, I started working, really diving deep on value pricing, and I started teaching other firms and built on that. I have firms of accountants who used to be charging £300-400 for that service, who then reported to me later that they were charging in the thousands, sometimes 10,000s. And I know one sole practitioner he's on my YouTube channel, got over 100 grand for a service that he used to charge a few £100s for. And it's just about understanding value pricing.
And this service you're talking about is similar to here in the US, setting up an S corporation for a client and helping them minimize their tax burden.
The terminology is a little bit different, but you have the same process. I was running a webinar just recently for Intuit, teaching tax advisory, and I went through that process in some detail. So it works. What I taught in the UK, I've also taught in the US since, and other than terminology differences, the process works just as well.
All right, well, we're going to have to dig into that, because taking a service that people are charging, £200 or £300 for, or what might be like $500 here in the US, and then getting tens of thousands or even 100,000 for it. I mean, I think everybody here is going to be interested to hear about that, as am I. And welcome to our attendees. Thank you for joining us, everyone. Feel free to put your questions into the Q&A. You can also comment in the chat. You can heckle me in the chat if you like. I always like hearing from our attendees. And if you are on LinkedIn, we are live streaming to LinkedIn. If you're on LinkedIn, I should be able to see your comments as well. So do let us know what you think, and put your questions to Mark. Ask him the tough ones about value pricing. So Mark, let's go right to it. What is value pricing?
Okay, well, really simple. It's about setting a price based on the value to the customer, not based on how many hours something takes. So it sounds really, really simple. Unfortunately, it's a little bit more difficult to implement in the real world. But that's essentially it. We come up with a price based on the value of what we do in the mind of the customer.
That's it. Just whatever the customer thinks it's worth.
Absolutely, that's it.
So this is always my challenge with value pricing, is like, what if the customer doesn't know what it's worth? And I feel this way as a consumer of accounting firm services. I have no idea what something should cost. It's not like I have a value in my mind. So how am I, as the service provider or the CPA, supposed to figure out what that is?
Absolutely, and that's a good thing and a bad thing. It's whenever we're customers. One of the things we learn from price psychology, in fact, going before that, a branch of science called psychophysics, is that we are, as humans, we're clueless about absolutes. And one of the things we know is one of those absolutes is price. We don't know the price of anything, which actually makes a lot of sense, because if you think about it, where does the price come from? It's why did Apple choose the price they chose when they launched the iPhone? And so there's no science behind why we come up with a price. We don't know the price of anything. And so what happens is, as a consumer, as a customer, what happens is, when we see a price, when somebody reveals a price, our brain goes off in its subconscious to go away and compare with something and come back in a nanosecond with some sort of feeling or emotion, like that's expensive, that's a bargain, that's a great deal, or something like that. So price psychology is extremely important. And so you're right. The clients have no idea what the price of something is. If somebody's never bought a tax return before, then they have no idea what the price of a tax return should be. And so that's actually an advantage to us, because we can use techniques to manage their expectations, to manage their maximum willingness to pay. And a lot of people think that value pricing is all about coming up with a price. And I would say, when we look at the topic of value pricing, which I've been studying for 20 odd years now, coming up with a price is a tiny part of the overall process. There are so many other things we have to understand, like how do we create value? And I think one of the most important skills we have to master is, how do we communicate value? What words do we use to communicate the value of what we do, so the client sees that value and understands it?
So in the case of a tax return, let's use that as an example, easy one. What is the value of a business tax return? Like, it seems like, right? It seems like it could be anywhere from a few $100s to tens of thousands of dollars. And that's a very wide range. So, I mean, for me, the hard part about value pricing is that range is so big. How do I know, when I'm talking to you, if you're my client, what that price should be?
Absolutely. And it's a great question. And as Ron Baker says, value is in the hearts and minds of customers. Everybody values things differently. And so our goal as a pricer, our goal as an entrepreneur, business owner, is to figure out, well, what is that maximum willingness to pay? What's that person willing to pay? And we have to remember that everybody's willing to pay a different price. So we have to price everybody individually. We can't have a standard price for a service like a tax return. Everybody has an individual price. But as you say, the challenge is, well, how do we know what that is? How do we know? And so one of the mistakes that people make is, and it's a big mistake, and perhaps we might get into this because perhaps we're jumping ahead, but obviously hourly billing is terrible. A lot of people move to fixed pricing, which is giving people a fixed price. So that might be somebody says, what will it cost to do a tax return? And we might say $750. Well, a single fixed price, fixed pricing is not value pricing, and perhaps we'll get into that. It's a big misconception. A lot of people think fixed pricing is value pricing. It's not. It's very different. But if we give somebody a single fixed price, if we say that tax return $750, the one thing I can say about that price with absolute certainty is that's the wrong price. It's the wrong price every single time. Because when you're talking to a client about your tax return preparation service, as you start to talk about what you do and communicate the value of what you do, in their mind, they'll start to come up with what they think is the most, what they're willing to pay. And the probability that the number that's in their mind is exactly the $750 you're about to mention is so improbable, it's pretty much never, ever going to happen. They will have a number in their mind that's either higher or lower. If they're thinking in their mind, this sounds like a cool service, this will save me some hassle, this has got to be worth $500. What's the price? What's the price? And you say 750, they're going to say, wow, that's too expensive. You lose out, they don't buy. But they might be thinking, if you get good at communicating the value, they might be thinking, wow, this is going to make my life so much easier. It's going to save me the hassle, the time, the stress with the IRS. This is going to be worth $1,500 I would pay for this. And then you reveal 750. Yes, they say yes. And you might be thinking, yeah, I'm a great salesperson. They said yes to my first price. No, that means you've left money on the table. And so what we have to do is figure out, how do we understand what's the most they're willing to pay? And one thing we can't do, unfortunately, is we can't ask them. We can't say what's the most you're willing to pay for this service, because they will either not answer that, or if they give you an answer, they're lying. They'll give you a low number. So we can't ask.
That's the first thing I would do. If you ask me, what am I willing to pay for a tax return? I'm going to play that game, right? I'm going to come in at the lowest number I think that I can give you without offending you.
Absolutely. And we must never do that. Another bad question that people ask is never, ever, when somebody wants some work done, ask them what their budget is. Because when you ask what the budget is, you give them control. When they give you the budget or the price they're willing to pay, then they're creating in your mind what's called an anchor in price psychology. And that anchor is going to influence then how much you then come up with. And usually you'll think, oh, I need to come up with something a bit less than that. They got control of the process if they go first with the price. So we can't ask. We can't ask. That's a crazy thing to do. So how do we do it? Well, there's lots of techniques, but the one that I've been teaching for 20 odd years now to accountants, and it's the thing that when we said right at the start, how do you get 3 times the price for that particular service? Well, it's using something which I came across in 1999 called menu pricing. I call it menu pricing. Everybody knows what it is now because we see it in the world around us. It was uncommon back in 1999, but it's basically coming up with different options. So you do not offer one tax return, you offer different choices of tax returns. Think of it as if you like. It's a bit oversimplistic, but it's the bronze, silver, gold. You come up with a bronze tax return, a silver, and a gold, and you give the customer the choice, because customers like choice. People like to be able to choose. I'm in the process right now of buying an Apple M1 mini computer. You go to their website, they give you 3 choices. Why? Because of the science behind it. It works. It's extremely powerful. And we can go into that if you want later. But the main reason you give people different options is because you don't know what somebody's willing to pay. Everybody values things differently. If you don't offer a super premium option, they can't choose to give you that, to pay you that amount of money. So by giving different choices, then the people that are willing to pay the $1,500 for the tax return, there's an option there for them to pay. The person that's only willing to pay $500, there's a cheaper package for them. That's how we start to go in the process of maximizing how much people will pay us.
I really like the Apple analogy, because I know as a consumer of Apple products and a huge fan of Apple products, that the cost for them to deliver each of those different products in those different tiers is often exactly the same. So there's not, the value is not linked to the cost to create the product. So an example would be in iPhones, they are often priced based on, I think the new ones are priced based on the amount of memory in the phone, whether it's a terabyte or 512 gigabytes or 256. It doesn't cost Apple anything more, not a material amount more to add RAM into the phone, to add memory into the phone.
Not. Absolutely not.
But they charge hundreds of dollars more in each tier, depending on how much storage you need. And I find that fascinating because the cost has nothing to do with the price. And I think that's something important that we have to understand and that we get stuck on. And it's one of the misconceptions about pricing in general, right? Or value pricing, is that like we have to completely de-link the cost to provide the service with what we charge for it.
Correct. Yeah.
So
and a lot of technology companies like Apple, like some of the car companies, you're right. The cost doesn't change at all. They just simply turn features off. They switch them off. You just can't access them. It's built into the software behind the scenes. It's in there. It's in their package. They just turn it off for that particular package.
Tesla is famous for that, right? All the cars have the same functionality. They all have the cameras, but to buy self-driving, you got to pay $10,000, right? Yeah. So that's okay. So let's dig into something you mentioned, which is the difference between fixed pricing and value pricing. So value pricing, if I understood you correctly, is it's trying to identify in the mind of a particular customer what is the price they're willing to pay for this service and giving them that price. And that's going to be different potentially for every single customer. With fixed pricing, like how is that different than value pricing? It's obviously a lot simpler, right? Value pricing's difficult because you have to like peer into the mind of somebody. And fixed pricing and value pricing, they can exist together, right? You can value, like you said, you have different tiers on your website, different prices. You might be value pricing into buckets, but you fixed a price. It's like, how can you clarify the difference for me?
Yeah, sure. And the confusion largely becomes because they think that value pricing is just simply giving a fixed price up front. But so hourly billing, which is the crazy way of pricing, obviously that's about the client says to us, what's it going to cost? And we say, we don't know, we haven't done the work yet, but trust us, we are professionals, we keep accurate time records, and when we finish the work, we will send you a nice itemized bill listing all the things that we've done. Customers hate that. We have to stop doing that. They hate it. There's been lots of research around that. I hate it when I deal with lawyers. As a customer, we want certainty. We want to know exactly what the price is right up front. And so I applaud all those firms that have made that shift to fixed pricing, because over the last 10, 15 years, there has been a big shift. And my most recent benchmarking study showed that there's probably as many firms now fixed pricing as there are hourly billing. But fixed pricing, it's still a form of cost plus pricing, because if somebody says, right, I'm going to charge $750 for doing a tax return, my question would be, okay, so where's that $750 come from? How have you arrived at that number? And the answer almost everybody gives is, well, based on my experience of doing tax returns over the years and knowing roughly how long a tax return of this complexity takes, I know this will take me about 7 hours. My rate's $100 an hour. So add a bit on, we'll go with 750. So it's still, that fixed price is rooted in us thinking about how many hours will it take? What's the cost of doing that? And not the value the customer's willing to pay.
Right. And like you said, some customers are willing to pay far more than $750 for the exact same return. And there are customers also that you might be turning off because they're willing to pay less. So by only having that fixed price, you're creating, discontent, or you're not optimizing what your firm could be earning. Like I'm going back to that 3 times, right? Imagine if you could charge 3 times what you charge now for a tax return. Like what kind of, at least even for 10% of your customers, that'd probably make a big difference to your bottom line, right? So there's a lot of money being left on the table. But value pricing is scary, right? And it's time consuming because you have to talk to the customers, right? The prospects. You have to like understand.
What, talk to clients?
Well, I mean, we don't have a lot of time, right? And I always struggle with this when I have my practice, is like the sales process, if you actually do value pricing, can be kind of like long, right? You have to spend a lot of time.
But then you have to ask the question, Blake, why do firms have a lack of time? It's because they're working crazy hard, crazy hours. Why is that?
Right.
Because their prices are too low, so they need to do more work to try and make ends meet. And so one of the things I say to people is, and I was there back in 1998, I was that sole practitioner working crazy. I had 250 clients. I was working crazy hours, struggling. And one of the things I did in 2000 that made a huge difference in my practice, and I teach this process now, it's a process for repricing existing clients. Just think of it this way. Imagine if you went to your clients and did it in the right way, but you said that you put all of their prices up by, on average, across your entire practice by 20%. And let's imagine that you put your price up by 20% on average across the entire practice. And let's imagine that some of them leave, which is actually a really good thing because we have clients that are paying the butt. And let's imagine that 1 in 5 leave. If 1 in 5 clients leave, let's just do the math for a second. What's your fees? Well, your fees you had before is going to be 1.2% higher, 1.2% higher because 1.2 times higher, sorry, because of the price rise, and then times by 0.8 because 1 in 5 leave. It's about the same number. And so your results are the same, but you're now working 4 days a week, not 5 days a week, because a fifth have gone. And so that was one of the first things I did in my practice, because what a lot of people do when they move to value pricing is they're scared to talk to their existing clients because they might lose them. So let's start value pricing with new stuff, with new clients. And that's a great thing to do. But at some point, if we're working crazy hard, crazy hours, we've got to tackle this problem. We've got to start repricing our existing client base. And we have to look at the bigger picture and recognize that, it might be a really good thing if 1 in 5, if 20% disappear and go, because that's going to create the space in your life to enable you to then start creating more value, have more pricing conversations, and start getting better results.
Yeah, we have to switch from just doing what's easy when it comes to pricing, which is send out the engagement letter with the standard hourly rates and get it signed and start working. And we've got to make time to have the conversations so that we can do a value price. And you're saying, raise your prices across the board, clear out a day in your schedule, which I think probably most firms could do, honestly, right? We have so much work. There's more work than we can handle. And like you said, you raise your prices 20%. Are you going to lose 20% of your clients? If so, great, right? You're ahead. You've saved time. We had a question come in from Tatiana. Mark, this one's a tricky one here. So my client, who I charged a value price after 2 years, can't afford it anymore. And now he's called other accountants who charge hourly and basically has broken up the services I included in value pricing, and he thinks it'll save him lots of money. So we've got a situation where somebody has been value pricing, now their client is shopping around. So with that, he's moving on because he thinks he will save $500, $800 a month. How do you avoid that?
Well, you can't necessarily avoid it. If the client can't afford you anymore, they can't afford you. You shouldn't reduce your price just because clients can't afford you. There's other business out there that you can then go and chase. Apple don't discount their prices just because you're on a tight budget and suddenly can't afford the next iPhone. So you should never reduce your prices. If they're looking to go elsewhere, then it could well be that they just don't really see the value of what you do. So it may be that there's a conversation around what's important to them. A question I would want to know is, well, why after, I think you said 2 years, why can they now no longer afford? What's changed in their business? Is their business having a downturn? Is there something that you could do around in the area of business advisory to help them improve their cash flow, improve their profitability? And so I'd be focused on, well, what more value can we create to help them with that problem? They must have a problem. And so I would be looking at putting the price up and doing more stuff. But if they don't see the value in you solving their problem and just want somewhere cheaper, there's not a lot you can do. Some people are just going to go for the cheapest, and you have to accept that and recognize you're a premium provider and focus on other clients that will value you.
Yeah. It's okay to lose clients. It's actually desirable to be shedding a certain percentage of your clients every year. Like that's
absolutely,
it's a good thing, right? Businesses do that with their employees. I mean, just look at the big accounting firms, right? That's the entire model of a large accounting firm is to shed employees, and they probably should shed clients too. They'd be better off if they did.
Yeah.
Well, so the transition is the tricky part. We're talking about that, right? We're talking about how we free up time to create room for value conversations, to work on value pricing. For a firm that is doing hourly billing right now, that's it. They're just doing hourly billing. How can they start on the path to value? Let's say they've raised their prices. Okay, they've made some time now. What's the next step to getting to value pricing?
Yeah, I teach something called the value pricing journey, because it is a journey. I used to years ago teach people to shift from hourly to value pricing. It's too big a jump, and people failed with that. So I realized you have to teach it in bite-sized chunks, little baby steps, one step at a time. And so if somebody's on hourly, the first thing to do is to move to fixed pricing, which we've said already is not value pricing. But if we can figure out a way to move to fixed pricing, it's then much easier to take the next steps in the journey. That's the hardest bit. The hardest bit is to go from hourly to fixed, because the big worry in our profession, particularly with work like bookkeeping work, cleanup work, where the scope of the work varies so much between clients and based on so many different factors. If we talk about bookkeeping, it's based on things like, well, how many transactions, how many bank accounts, are they registered for sales tax, do they have credit card accounts? There are so many things that impact on how much work is involved that people struggle with this whole concept of how can I give a fixed price, knowing in advance that will make me money and make profit. So we have to come up with a system. We have to come up with a process for that. And I had this exact same challenge back in 99, 2000 in my accounting firm. Now, I didn't do bookkeeping then, but I did end of year financial statements. And I was trying to figure out, I'd come across value pricing, and I was thinking, well, how do I give a fixed price upfront to a brand new client for doing their annual financial statements? And I figured out, well, there's certain things that impact on the amount of work. I call them the scope factors. The scope factors are things that impact on the amount of work. And there's always one primary scope factor. There's one thing that impacts on the price more than anything else. And that was, in the case of annual financial statements, is how big is the company? In other words, if I had a brand new client that did $1 million in turnover, I know that I would be pricing a higher price. It would take me longer than one doing 100,000. And so that was the primary scope factor. If it was bookkeeping, it would be number of transactions per month, for example. If it was tax returns, it might be number of sources of income. If it's payroll, it might be how many employees. There is some sort of primary scope factor that has the biggest impact and the strongest correlation with how much work's involved. So what I did back in my accounting firm, and what I teach people now, is we can do some analysis called regression analysis. Now that sounds complicated, so I'll just keep it simple. But essentially all I did was I got an Excel spreadsheet. I picked 10 clients at random in my practice, and for those 10 clients I chose, what was the primary scope factor? What was the size of the business, and what was the price that I was charging them, or knew I should have been charging if it was the right price? And then you can plot that as a graph on Excel. You can do regression analysis. It does what's called a line of best fit, and that gives you a formula. And you could use that formula for pricing. Now, it's not a perfect formula because all the dots, when you plot it, won't be on a straight line. And so some of those clients will be higher priced and some lower. And so it's not an accurate formula, but that's not a problem because, and there's a number of reasons for it, but let me just give you two of them. One of them is the fact that we've only looked at the primary scope factor. There are other things that have a difference and an impact. If it's annual financial statements, it's not just the size of the business, but there's more work for a corporate than a sole proprietor, because with a corporate, there's extra filings and statutory disclosures and all sorts of stuff. So corporates are always more expensive than a sole proprietor for annual financial statements. And so I would then have a look at those clients and say, well, okay, those that are corporates probably need to be an extra 20%. So I'd amend the formula to add on 20% for corporates, for example. So these are what I call the secondary scope factors. Mm-hmm. And you can start to get to a stage where you get a fairly rudimentary formula that's going to give you a pretty good guidance as to what the price should be in advance. Now, it's still not perfect. There's some other things that we need to think about. But one of the things that we then want to do is recognize that once we've got that formula, once we've got some sort of process for coming up with a price based on our knowledge of that client, the scope factors, we then want to recognize that this is just the starting point of moving to value pricing. This price that comes up should only ever be a base price, a minimum price that we never go below, because then we can move to the second stage of this journey, which we've talked about already. I call it menu pricing, where you give 3 options. So what you might do is you might say, when you're a beginner at this process, what I recommend is, if you're new to this, then make your cheapest option the bronze one, if you like, based on that formula. That's probably going to give you, should most of the time make you money, be profitable. But then with your middle and top options, you add much more value and you charge higher prices accordingly, not based on the time it takes, but the value. And you use your judgment of value. And the great thing about our profession is that the compliance work, the stuff we do anyway, is usually the stuff that takes the most time. Bookkeeping, it takes a lot of time, whereas the stuff that adds more value very often takes very little time. So that's creating the reports with ratio analysis in. We can have a piece of software that touches the button, and within a few seconds, we've got a beautiful report. That's hugely valuable. Doesn't take much time. The extra meeting you have to then interpret those numbers, it's only an hour of your time, but there's so much more value we can give in that hour-long meeting than the crunching of the numbers. And so as we create more value for our clients, it gives us the opportunity to create higher prices, even though we know it doesn't actually take that long to do those extra things very often, like the reports that come out of the software. And so when we create the price for our middle and top options, we come up with a price based on our best guess, our judgment of what we think the value of those extra things are. And then what we do is we sit back and we see what the marketplace says. In other words, if, let's say, you've got 3 tax returns, bronze, silver, gold, in the middle and top options, you've got some extra stuff that delivers value, and you've come up with a judgment of price. And over 3 months, you've perhaps had 30 pricing conversations with tax returns. If most people choose your premium one, that's the marketplace's way of saying they value those extra things, and we should perhaps put the price up even higher. If they all choose the cheapest one, that's the market's way of saying we're not sure we see the value in the things in the premium package. So you then just see what the marketplace is saying, and you adapt your prices accordingly.
And going back to the Tesla, the Apple analogy, these differentiators may have nothing to do with the amount of time it takes. Very little link between that. And one that I like to suggest is access. So to different personnel in your firm. So if your firm has, staff level, manager level, director, partners, you could say that you're only going to have your tax return reviewed by a partner if you are on the gold plan or higher, and that bronze and silver, that's our team doing the work for you. And so, that review might only take you 15 minutes as a partner, but it adds a lot more value in the mind of the client or the prospect, because they're getting peace of mind that you're part of the process. And that's hard, I think, because in a lot of firms, it's just a given that we're gonna run every return through the same review process, but your clients may not need or want that. So one thing I want to go back to, I love what you were saying about creating this pricing model based on number of employees for payroll or number of transactions for bookkeeping. I did something very similar in my firm. We did primarily CAS work, bookkeeping work, outsourced accounting work, and we had 3 services essentially. We did bookkeeping, payroll, and bill pay. That was like the 3 things we did, and it was easy for me to price in terms of value. I don't know if I would call it value pricing, but it was like a scaled fixed pricing where I had different tiers based on number of bills for bill pay, number of employees for payroll, and then for bookkeeping, we actually did it based on a percentage of revenue or expense. So it wasn't even based on transactions anymore. It was based on the size of the business in terms of their revenue, because we'd figured out how to automate a lot of the transactional bookkeeping. But that still, just building that model can be a little challenging. It takes a while, right? I don't know. It took me like months and months to get it right. I feel like maybe even years. And so I wanted to offer something to our attendees. If you are on an hourly billing situation and you really just want to get to fixed pricing, Financial Sense, the organizer of this series, the host of this series, has a report in their practice management software that we're going to take a look at here. It should be coming up on the screen soon. And it's a very simple way with this. This is called the effective hourly rate report. So if you are using Financial Sense, you can track your time in Financial Sense, and you can see on a per client basis, right? We got client on the left column. Then with the next column over, we've got amount billed. Then we have time tracked, and we have your effective hourly rate. You can get an idea on a client basis what amount of time you're putting in and the amount you're billing over a certain time period. And so if you really just want to move to a fixed price, like the simplest way to do it is to look at, what did we bill last year to the client and fix a price based on that. And maybe, add a little bit for Mark, just to be safe. Like, Mark, do you think that's a fair way to like just really quickly get into this? Would you advise,
Sure, yes,
a student of yours?
When we're moving along this journey from hourly to fixed pricing and then starting to dip our toes in the water with menu pricing and some of the other value pricing techniques, there's nothing wrong with doing analysis like this to make sure that we can then compare and check that the prices that we're giving clients, the fixed prices with value built into it, is giving us better results. So having some sort of be able to look back and say, okay, I value base, or I think I value base this client. They paid us 5,000 for this project, and looking back at perhaps the time records and the analysis and stuff, that looks like that was a profit. That was worthwhile. We got the price about right. So there will be a learning curve. There will come a point at some point, if and when we master value pricing, where we don't need the timesheets anymore. But initially, we can use them just to validate, sanity check, make sure that what we're doing is on the right lines.
Yeah, and I feel like this is a bridge for in a firm where you've got partners who they still want the staff tracking time. You want to move to value pricing. You can't get rid of the time tracking. Like you have to have this transition that happens where you're doing, it's sort of like running 2 GLs simultaneously for a period of time, right? You don't want to have to do it for too long because it can be really time consuming and a waste. It can be wasteful, but also you want to make sure that your new system works. And so you can continue to have the team track the time. You can start value pricing, and ideally you can show that, hey, our effective hourly rate has significantly gone up now that we are no longer relying on timesheets to bill our clients, if you do it right. Of course, there's also the risk that you won't price it right, and your effective rate will go down, which I suppose is one of the pitfalls of value pricing. You're taking a risk, right, Mark? What about that, and how do you mitigate it, and what are the other pitfalls we got to watch out for?
Yeah, the pitfalls. I mean, a good example is when people do cleanup work. I've seen people say, I had to go at fixed pricing or value pricing cleanup work. I got it wrong and I made a big loss on it. Well, that's not because value pricing is a bad thing. It's just that you didn't do it. It wasn't done right. So we have to learn from that. If we give, and this is whether it's a fixed price or value pricing, if we give a price and then we do the work and figure out, oh, actually we should have charged much more, and that will happen in the early days particularly, we need to treat that as a learning point. We have to ask the question, well, why? What did we get wrong? And it could be that we just didn't identify the scope factors properly. Perhaps we didn't realize the scope factors. It could be that we didn't do a great job at communicating the value. And so we struggled in the pricing conversation, and we let the client beat us down on the price and negotiated because we didn't communicate value. That's such a critical part in the process. Another big reason why as well, and this is an important one, is scope creep. So, and this happens a lot with, for example, bookkeeping, that an accountant will sit down with a client. They might do some analysis and look at how many transactions a month and so on, and come up with the price for doing the bookkeeping. And it may be a monthly figure, and it might be fine for a couple of months, but by the end of a year, you suddenly realize it's taking way longer. Why? Because the business has grown. And one of the things that people don't need to do better is when we agree a price with the client right up front, it's really, really important to make sure it's clear in our verbal conversation and in writing, what is the scope of the work? What's the basis of this price? And if it was something like bookkeeping, we might say this price is based on the fact that you currently have X number of transactions. If it's payroll, this price is based on the fact that you currently have 5 employees. And then what we should say and put in our agreement is, just so you know, if that number changes, if you hire more people, the price will go up. And if you hire less people, if you make it will come down.
Oh, yeah.
And if you said to the client, does that seem fair? Yes, that seems fair. And so one of our problems is we don't communicate very well. We don't communicate the scope of the work, and therefore we just leave it. And then 6-12 months later, we realize things have changed, and now we've got a difficult conversation to have because we didn't manage their expectations right at the outset. So we then think, oh, let's just leave it. I don't want the awkward conversation. And we then just keep taking the hit.
Yeah. So you got to have that's we keep going back to having the time to have these conversations, right? You cannot be working at, 80%, 90%, 100%, or 110% capacity. It's got to be 80% or less. You got to have a day a week to focus on this stuff. And sure. I really like the idea of having very, very defined scope, number of employees for the payroll services, number of transactions or revenue or whatever it is. So that it's very easy to increase that price when appropriate, and you don't have to have some sort of amorphous, painful discussion about it. It's very clear, and it was part of the original engagement. And one thing that I've seen firms do that I love is build that increase or decrease into the engagement letter. So when they sign up, it's clear that if something changes, your price is going to go up, and I don't have to go get a new engagement letter from you. I'm just going to increase your price and let you know, right? And that way you've automated, in a way, those price increases. And if it's based on a very clear scope, a very clear metric, then it's easy to do. Yeah.
A lot of the firms in the Value Pricing Academy use my effective pricing software, which enables them to have that pricing conversation in front of the client. And then it creates that transparency. The client can see how the price is changing, and they can see how it's been built up. And that then makes it much easier to then say, let me just show you what the price would be if this happens, if you had less employees. Let me just show you the price. And then that creates that complete clarity, so that then if that eventuality happens 3-4 months down the line, it's not a surprise when the price has to change, because they were involved in the pricing process. They saw how the price was being built up.
Yeah, the clarity that you get from hourly billing, if you can achieve that in value pricing, then the fear is gone. Yeah. That's the biggest problem. Yeah. Folks, we are nearing the end of our time with Mark today. So if you have any questions, now's your chance to put them in. We got one from Joel. Joel said, primary scope factor changes annually. Would you have a threshold to adjust if it grows too much? And how about if the client shrinks? What if, for tax purposes, the client splits the same activity with a new second entity?
Okay, Joel, great question. So yes, it depends on the service. But for example, let's take bookkeeping, where your primary scope factor might be the number of transactions, and that will vary every single month. So you wouldn't say to the client, you're doing 100 transactions a month right now, but next month, if it's 101, we will change the price. That would be crazy. So much more sensible to have some, we use the word bands. So we might say to the client, if you have between 50 and 100 transactions a month, this is the base of the price. You've currently got 75. If it goes above 100 and you have 100 to 150 transactions a month, this is what the price would change to. So you just create some sort of system, some clarity. So up front in that conversation, you create that clarity in the client's mind as to what would constitute a change of scope and therefore a change of price. And sometimes that's not the one extra employee you take on. It could be that if they've got 50 employees, it's not till they get to 60 employees that you put the price up.
And Joel wrote it again to clarify, he's talking about a tax return. So I guess the idea is like the client now has a second entity and you're doing 2 tax returns instead of 1. I mean, that to me seems pretty clear. It's going to be more work to do 2 than 1, even if the total business activity is the same. So, I mean, you should be increasing your price at that point. I mean, that's if the client doesn't want to pay more, maybe they shouldn't create more entities, right?
Correct.
So let's see. I think that's all we have at this point.
Okay.
Mark, tell us how people can connect with you, learn about the Value Pricing Academy. Where should they go?
Yeah. Okay. So best thing to do, I think, let me give you two things. So firstly, feel free to connect on LinkedIn with me. And so my name's fairly easy to remember, or not remember, but it's unique. Mark Wikersham, you'll find me on LinkedIn. And if you connect with me on LinkedIn, one of the things I'll do is when an accountant or bookkeeper connects, I will then send a message back with a link to a whole bunch of free resources. So LinkedIn's the first way, or you can go to my website, which is www.wickersham, wickersham.co.uk, because I'm UK.co.uk. And if you go to my website, I think right at the very top of the homepage, it says get started, and that will take you to a page with, again, a whole bunch of free stuff. So I have lots of free stuff for accountants and for bookkeepers. For example, I've just written an ebook on ChatGPT for accountants and bookkeepers. It's 30 odd pages. If you want it, I'll happily send it to you. Just connect on LinkedIn. I've got ebooks on how to price bookkeeping, for example, how to price cleanup work. Just connect and I'll send you all my free stuff.
That's great. And yeah, we didn't even mention ChatGPT today, but I mean, if anything's going to kill the timesheet, I feel like generative AI could do it, because what are you going to do when a client used to ask a question and you had to spend an hour looking up the answer, and now you can type it into ChatGPT and get an answer that you can then vet and send back, and now it only took you 10 minutes. Are you only going to bill 10 minutes of time for that?
Yeah, I think the profession is underestimating the current pace of change. Just in the last 3 to 4 months, it's extraordinary. I use ChatGPT every single day. It saves me hours of time. Once you've figured out how to use it, it's extraordinary.
It's amazing. Well, Mark, we'll leave it there. Thanks so much for your time today. Enjoy the sun in Portugal. And yeah, we'll see you around.
Awesome. Thank you, everyone. Thanks, Blake.